Welcome to this explainer. If you've been trying to buy a house, thinking about starting a business, or, let's be real, just wondering why your grocery bill feels like a blindfolded roller coaster ride, yeah, you know the economy feels completely unpredictable right now. But today, we're not just guessing what happens next. We're going to diagnose our financial health using a highly precise, data-driven framework. We'll get through all the noise and give you a clear, understandable picture of exactly what's coming over the next few years. To figure out exactly where interest rates are heading, we're relying entirely on a framework called Triune Harmonic Dynamics, or THD for short. This was created by researcher, inventor, and author Kevin L. Brown. And honestly, this framework is fascinating. Instead of just looking at the stock market's daily mood swings to guess what Wall Street might do tomorrow, THD acts more like a seismograph for the economy. It actually measures the hidden pressure building up deep inside the financial system to predict exactly when major structural shifts, or, financial earthquakes, have to happen.
Okay, here's our diagnostic roadmap for this explainer. We'll establish the framework, check the current economic pressure, look at the forecasted prognosis, map out the timeline, and finally, set the rules for what would actually prove this forecast wrong. So, let's start with the basic rules of the THD framework to see how the economy actually moves. Kevin L. Brown's research shows that financial systems cycle through three distinct phases. Think of it like stretching a really thick rubber band. First is the base phase. This is the rubber band resting in your hand. Inflation is stable, interest rates are predictable, everyone feels comfortable. Second is the pressure phase. This is when you pull that rubber band tight. Uncertainty creeps in, the market gives mixed signals, and policymakers start hitting their limits. Finally, we reach the integration phase, the release. The rubber band either smoothly relaxes back into a normal shape, like a gradual rate cut, or it snaps entirely in a hard structural reset. Applying this framework right now, what's our current diagnosis for the U.S. economy in 2026? Well, the data shows we are officially in the late pressure phase. This means the economy is caught in a seriously intense tug-of-war. On one side, the system is pulling with absolutely everything it has to stop inflation from staying too high. On the other side, it's desperately trying to protect economic growth so businesses don't go under. If they pull too hard to stop inflation, boom, they accidentally trigger a massive recession. But if they let up just a little bit to protect growth, everyday prices just skyrocket out of control again. The system is totally constrained, the rope is fraying, and the tension is rising literally by the minute. Now, I want you to focus on this number right here, 32 out of 40. This isn't just some random fraction or a mediocre grade on a math test. It's a highly specific measurement, a critical gauge showing exactly how close we are to the breaking point. That number is the Structural Pressure Index. It looks at 4 critical factors to give us a health score. Let's translate these real quick. Leverage stress is basically how much heavy, expensive debt is crushing the system. Liquidity risk is how easily cash can actually flow when people panic and need it. Institutional rigidity is how stubbornly slow our big banks and policies are to adapt to new problems. And finally, signal divergence. Added up, a 32 out of 40 is basically a giant flashing red light on our dashboard. It shows a dangerously high chance of a system rupture, mostly driven by hidden stresses, like a surprisingly weak long-term bond market. And this perfectly illustrates the biggest problem we're facing right now, which is that fourth factor, signal divergence. What we see on the surface simply isn't matching the structural reality underneath. It's kind of like driving a car, right? The dashboard tells you the temperature is fine, everything's improving. But if you pull over and pop the hood, the engine is actually smoking. On the surface, the signal tells us inflation is getting better. But underneath, the reality is that inflation is stubbornly stuck above the neutral safe zone. We're operating dangerously hot, which makes that improving signal incredibly deceptive. So with pressure building this high and the dashboard giving us completely mixed signals, what is the actual prognosis for interest rates moving forward? How does this all resolve? The THD forecast outlines 3 clear paths. First is the base scenario. In this world, rates just stay stubbornly high, stabilizing in a 3 to 3.5% range, with very slow adjustments. That means buying a home or expanding a business stays pretty expensive for years to come. Second is the acceleration scenario. This is kind of the nightmare path where inflation actually spikes again, forcing policies to tighten and driving rates even higher, completely choking off growth. The third path is the containment scenario. This is the dream, the Goldilocks zone, where inflation drops cleanly and interest rates normalize smoothly without breaking the economy at all. Knowing the possibilities is helpful, for sure, but let's check the calendar to build a precise timeline for action. Because in finance, knowing what's going to happen is only half the battle. Knowing exactly when is everything.
And the THD timeline leaves very little to the imagination. This isn't some vague sometime in the future prediction. We are in the pressure cooker right now. We're currently in the late pressure phase of 2026. The primary window for a major policy shift or a massive market adjustment is concentrated tightly between 2026 and 2028. This is when the pressure is mathematically most likely to force a resolution. Now, if the system somehow manages to suppress this incredible pressure, it doesn't just disappear. It just gets kicked down the road into a secondary extension window between 2029 and 2030.
Now, any true data-driven forecast has to have strict, transparent rules for how it can be proven wrong. We cannot just make sweeping predictions without accountability. Let's look at the test mechanisms.
The crucial point here is that this THD forecast by Kevin L. Brown actually holds itself entirely accountable. The prediction of a major structural rupture is officially proven false if 4 very specific things happen smoothly. 1. Inflation hits its target and actually stays there without bouncing back up. 2. Long-term rates drop without triggering any sort of market panic. 3. The public and investors fully trust the policymakers again. And 4. Credit markets remain completely stable under current rates. If we see a flawless, smooth landing on all 4 of these points over the next few years, well, then the pressure gauge was simply wrong. But as we enter this incredibly tight, highly pressured time window, the data tells us we are absolutely at a definitive tipping point. The ultimate question you need to ask yourself as we wrap up this explainer is this. Will the U.S. economy somehow pull off a miracle containment by 2028, finding that perfectly smooth resolution? Or is this massive underlying structural pressure going to snap the rubber band once and for all? You're going to want to keep a very close eye on the bond market and the inflation data over the coming months because the engine is running extremely hot and the answer is about to reveal itself right in front of us.